Hey, good evening, guys. Microphone check and screen share check, please. Alrighty, let's go ahead and get started. This is Tortoise Capital Nightly Strategy Podcast for May 21st, 2022, Saturday night edition. So we're looking at trade frames. And we'll begin with Chi Wing Chong's contribution here on the sector cycling. So let's see what we got. All right, so we've got the market Z-score rolling over here at about Z minus 2. Finance continues to be the weakest. Materials and tech made the turn sooner at 2 sigma. They're still hurting at minus 1.5, and they're all lagging behind energy. But that's this is an indication that this big leg of downward sell-off is over, and that it's hesitating at a support level. This just means the rate of sell-off has slowed down, led by energy. This is not. It's improving in the sense that it's not failing as wildly as it was before. But energy leading the way, finance still lagging. So value pickers would be looking at finance and bonds, I think. And then in the battle between staples and discretionary, boy, they really took a hit this whole week. For the longest while, you know, there was this advantage between XLP and XLY, but that all got erased this week with some violent sell-offs. And those of you trading along with us during the day have seen that in Walmart, Conagra, Archer Daniels Midland, can't remember GIS, the other food company. But all of these staples have really taken a hard hit. And now when the defensive sector has suffered and is down here and arguably worse than the market, which has stopped failing as fast, that's really a trend that I'm going to continue to ride as long as that is suffering. So I'm looking at things like Disney, Home Depot, Coca-Cola, Archer Daniels Midland, Walmart especially. We've been doing very well with Walmart. Yeah, Lowe and Costco too. Thanks. So all these little members of XLP are really getting smoked. XLP itself has been a tradable symbol too. And that's got options and futures on it as well, for those of you that just want to play the sector. I will jump into the series of frames from Ken H. And thanks, as always, for his due diligence and leadership and friendship. All right, so we got Netflix has just hadn't been able to recover from this huge earnings disappointment. And you had 1, pause, 2, pause, 3 legs down. And now, as Ken H is showing us, we got this converging triangle where it is coming into a critical state where the least likely result is staying further compressed. We're going to get some kind of breakout either this way, and it's got to get above 200 to become interesting. So this is like tactical target 1. That's about 15 bucks from 186 to 200, which is just within the noise of the market. That's it. That's this trade right here, going from here to here. So that's 15 bucks, and he's mapped out about a $5 risk. So from here to here, you get almost a 3 to 1. My spider sense is that if you're trading this on shorter than an hourly chart, like maybe on a 30 or a 10, you could probably get away with a $2 risk. Let me see what the see if our spreadsheet has anything to say on that. Well, yes, it does. Netflix, $1.83 is the R10, so $2 was a pretty good call. Yay me. So this is what that looks like on our on the auto framer, and using the daily chart. Now that's pretty interesting. The way that has compressed so tightly, you can see the 1-day range here. That's this. The 5-day volatility, small, and then the 10-day has been so tight. This thing is just screaming for a breakout. And again, it's got to get above, the target to 200 is certainly there. Then, the next upper limit is about there. And, the optimum return would be up there to 250. So there's plenty of upside in the tactical new world order, if we want to put it that way. That's sort of the maximum reasonable upside. And you'd have to say, where's the earnings coming from that's going to make that valuable? I don't really see that happening. So when we come back and look way, way back, this thing is just, you can ignore all previous valuations and look at this strictly as a, transactional consumer company. So the doji's interesting, because if you can play the breakdown from about 180, you can get to 160, and that's an 11% move just to the 10-day low. So I like Netflix there. That's a nice frame. Let's come back and you can see how the his multi-time frame has really captured the essence of this thing. The horrible, miserable, bad, not good sell-off from 700 to 180. The slowing of the pain and suffering here as the new valuations reflecting the new earnings comes in, and is almost forming a kata 2 inside here. It is kind of a kata 2. And then the range compression on the hourly. And again, if you can manage that on a $2 risk, with the range compressed this tightly, let's go take a look at that on 10 minutes to see what kind of price actions we're talking about over the last, say, 5 days. I'm going to draw a $2 box so that we can get some sense of scale. That's what 1/10 of a range stat is. So what I want to show you here is that after an extreme move down, like this breakdown from last week, gap down and sell off with a $2 risk box and a collapsing dragon, you can actually get 1, 2, 3, 4 of those $2 boxes on an intraday, and then followed by another one up, followed by another one down, and rebound in the same day. So this is kind of perfectly placed, for a, we would call that a fence sitter being stuck right in the middle, and now a $2 breakout out of that $2 box right there. I like that in either direction. to be honest, because even if you just get the move down here to 180, you're still talking 3 to 1 and then 5 to 1 down to the 5-day low. So that feels actually really, really good. Netflix. I'm using a $2 minimum manageable risk box as my initial ballpark estimate of what is tradable. And that's on a 10-minute chart. If I'm on my typical 3-minute chart, and if I shift over to the sniper frame of reference, if we just looked at yesterday's trade and we set a $2 box, looks like this one. You can see that you got a nice manageable move, like the PSAR to PSAR stretch is 187.50 to 188.7. That's only $1.25, so you could actually manage $1.25, and then that move, when you get the sniper PSAR, that would have allowed a short at 187, and then you never even get out of that until this probably gets you out at 184. So that's almost a $4 move on a buck. That's almost a 4 to 1 trade right there, followed by a second collapsing dragon, and then a couple kata twos that probably scratch, and then the last minute run up. So it looks to me like Netflix is going to be very tradable when you see how much intraday volatility there was over the last 5 days. And, if you follow this bouncing ball, what you had was 2 days of sideways chop, then a decisive breakdown, a strong rebound, and then an intraday reversal, which says that this is kind of coming into the station and getting ready for big moves next week, right? So you had indecision for 2 days, big down, big up, and then half a leg down, half a leg up to close right in the middle of that 5-day range. That's pretty nice posture for a fence sitter in Netflix, which has already seen all the pain and suffering it probably is going to be. So if you just take a look, if you think about our standard approach to trading from abnormal conditions, right? You can see that this offered you an SSC. This one offered you a kata 2 that was really strong. And then what you had was this chop, then decisive day down, which got halfway back towards the 10-day low, halfway down and held, strong recovery, and then you got this indecision day, which looks like a trader's paradise, which brings it right back into the middle of the range, just ready to break out. So if I'm looking at this, right, I'm just going to make a prediction about the future, and I predict I'm going to have about a dollar breakout on this, so that I can trade from this. This was the last trade box right there. I bet you that I'm going to trade that as soon as it breaks out of this box, and looking to trade to the 5-day highs like 191 and 176. I don't know which way that'll break. Nobody does. But when it breaks out of that, that feels pretty good. Ken H., is that making sense to you? So that's that simplified sniper execution frame. That's on 3 minutes, which I think is manageable for intraday. if I dial it back to 10 minutes, this is what that daily move, and even that daily move gives you some possibilities. Like you could get that, if you saw that peak and you saw it come through the dragon and get the PSAR flip, you end up getting short at that dot. You probably use $2 to the top of the dragon, which would be up here, and then from 185, you're not really you get all the way to 179, so that's $6. So that's a 3R move on a wide $2 stop with an easy exit. Because remember, now on the 10-minute, look how nice the RL10 crossing the baby dragon is in terms of an appropriate moment to get out. Like, that's when you should be exiting. You should be getting out on a 1-2 exit, like right there at the edge of the dragon. You could even trade from the PSAR to the edge of the dragon as your stop and be perfectly happy. Because even if this got you out, that would get you back in on a resumption of the trend. So that feels pretty good. And then your COT at 2 is really nice, even on a 10-minute. All right, so that's Netflix. Here's Cisco. Has gone from 62, has crashed through support at 54. This double bottom failed. This is the argument, by the way, for the collapsing dragon pattern, right? That when that collapsing dragon fell, you got to move from 55 down to 50. That was -5 in a week. And then this one goes from 54 to 42. 54, 42. That's -$12. That's a 25% sell-off. And on the weekly, it hasn't bottomed out yet. 38 is certainly within range. And here's your. We're going to see the trade frame over here. That's where the price is now. So this move back down to 38 and support is easy to see, and that's where you want another position as a swing. It has to contend with this gap on the daily basis, which sort of puts a lid on it at 44. So your first move up, if it gets to 44 and starts to stall, you cash. But if it gets through 44, you'd like to get a second position on quick, as he shows here, because then there's little resistance through here, and it should run up into about 49 pretty easily, right? And you can see that the failure is easy because you don't get actual support until 38. So you're talking short at 42 down to 38 is a $4 opportunity, and you can see that his risk is about $1. So that's a 4-to-1. And then if we come over and look at it on the hourly, again, this is where it has to get out of. It has to get above. I'd say about this level, really. He's showing 44.51. He wants to see it really get this far and to be clear of that resistance to show that it's actually making the move back to the Bollinger Band mean, and then closing the gap up in here. So waiting that extra piece just makes sure that that first one has had a chance to earn some money to give you a cushion, and that it really has left behind all of this previous support. So now it's, by this time, it should be ready to go. So yeah, that's a nice one in both directions. Now if we come and look at Cisco over here. Yeah, that's about the same thing. It has to get above 44 to be interesting. So you do have a window in here. Now, this is showing on the 10-minute chart, and it's only about a 20-cent risk. So if you were really looking to exploit the intraday, you'd almost have to have that small of a box to make that move. Let me see if we can pull up the S&P real quick. I think Cisco's in the NASDAQ. Yep, there it is. So, yeah, 20 cents. I'm doing pretty good on that. So the R10 on Cisco is 18 cents, so call that 20 cents. That's about a 20-cent box right there. So if you got a breakout above, call it 43 with a 20-cent initial risk, you could reasonably play a 5-to-1 reward to risk ratio just to get back to the to this 2-day high where it really has to get through. This is no man's land here. This is all of the gap area. So it's a tactical trade to 44, and then if it gets past 44, then it's all systems go. Then you might do something like putting a halfway point. If it gets halfway through the gap, 46 is in play, then 48, and then it's a new a whole new world. So I would be looking at this as a representative of old school tech that has suffered like the rest of the tech sector, and which has been getting punished, and if tech started to make a recovery, you know, now you can see the 10-day high and the 5-day range. You can see just how volatile that 5-day range has been, and that puts this into a nicer perspective. If I go back to the daily, and I'm looking at the 5-day in blue, then 10-day, 30-day range, you can see that this thing is in Godzilla territory because the 5-day volatility is so large. Heck, the 5-day volatility is half as big as the 150-day range. That's how violent this thing is. And then, as you can see, it's in the bottom of its 10-day, 30-day, and 150. That's so Godzilla that you can't stand it. So you really don't need to know more than that. If we looked at it on the auto framer again, it's even a little cleaner to see. So yeah, I love Cisco right now. Finding good ones today, my friend. Twitter being held hostage by Elon Musk's posture. So he was committed to buying that thing at 54, and now it's at 37. So that's about a 33% sell off, and is kind of consolidating in here, as you can see. This is a cheap and easy way to play the volatility in Tesla. When Tesla's getting pounded, Twitter goes down because it makes it harder for Elon to buy it, and then now nobody's going to pay $54 for Twitter. So the breakout is interesting. I would be watching, if we saw Tesla, I would watch this as a pair trade with Tesla. If Tesla starts moving up, it makes more likely that Twitter gets bought, and then Twitter's a cheap way to play the rebound. You got a consolidation here at 41. That would be my first target. So you're really playing about a $2 move on about a 50-cent risk at most. Yeah. And then the downside's very easy to see. That's probably what it's really worth down here. So Twitter looks good. It has a 30-cent R10. That's what our abbreviated sniper move looks like. Dramatically oversold. The MACD histogram ready to start popping to the upside. So that's going to be a nice move on the rebound. That would be the most painful for everybody that was short-term short this thing. That looks like a low-risk idea in both directions. So another good find. 30-cent intraday risk box. What's that look like intraday? Let's shift to the sniper view. Dial down to about a 10-minute. So that's about a 1 day on a 10-minute. And if I use a 30-cent box, it's this one. Whoops. How did that happen? Oh, I see. So if I'm using something like a 30-cent box on this thing, that rollover and breakdown here, tradable. The SSC is really tradable. And you can get away with, just on the 10-minute bar, you're really looking at only about a 20-cent box. So you got plenty of upside to use on that. And you'd be very happy if you did. And what's really nice, here's a quick quiz for you. That's not even an SSC, is it? You'd call that a COTA 2. 10-minute, 20-cent risk. Nice. So that means I can bring this up here, take a look at the close, and put about a 20-cent box on the opening, and then play the first 20-cent move away from the open that you get, almost like a hybrid frog. So that's what Twitter looks like. That looks pretty good. Have to come back and visit all these tomorrow. Coca-Cola. This looks like a perfect morning hook on the weekly and daily. This was part of that, punishment of everything in XLP. You can see the size of that sell-off on the weekly. When even the old reliables were out getting murdered. So you can see this went from 66, down to 60, minus 9%. But is stabilized around 60. And even with a nice tight box in here like this. So I think on a swing basis, sure, you could use that wider stop like this. But if you're playing this one intraday, I think I like the smaller box. I think I'd be looking at Have to look at the S&P 500 for Coke. Yeah, so Coke's about 22 cents, so roughly a 20-cent risk box. And here's what 20 cents looks like. So if we take that rascal and bring it, that's, yeah, so 22, maybe 25 cent is probably better. If you're using 10-minute, yeah, 25 cents. And you're happy with that. And then the Kata 2 entry right there is pretty strong. Yeah, that's a perfect Kata 2. Which is attractive given the double bottom that you're getting there. So that Kata 2 becomes even more compelling. That looks good. Merck, this looks more like a fireworks mover, right? Because it's at the top of its 150-day look back. You got Kata 2s all over the board, all the way up. So if that just keeps going, it's already cleared the RL10. So that thing is just free and clear. Your most recent support level is here. So if this breaks out, it only has to get above 94 to be all-time high, and up it goes. But if this fails, you get your first target to here, and then if that fails, it's probably to here, and then to here. So I'd probably add I like that, a second position right there. And then if this starts to recover, you just cash it. But if this fails, you could think about a third position there. Boy, that looks good. Merck. Let's look at that one on the old reliable here. And we're going to see what a fireworks looks like. For those of you on the intraday, the Merck has about 27 cents or 30 cents for an intraday box. That's what he looks like. Yeah, we've been tracking this one from all the way back from this SSC. And from this Kata 2, we were using the regression line, direct regression line slopes to get a feel for that. Then you get this Kata 2, which really paid off well from 87 all the way up to 95. And that looks pretty good. I'm liking that. Is that an all-time high? Yeah. There's no resistance overhead on that whatsoever. Once it gets through this high right up here, this spike high, it's already at the highest close ever. It just has to get through 94.50. Boy, that's a no-brainer. McDonald's, a harder sell. This is only useful in the sense that on a relative basis, like you can say the pain and suffering was overdone in XLP, so you have sort of a wild Kata 2 forming if you think it can get to 25 or 250, and you have a very tight risk box in here, about $2. That's $2. And then the fail back down here is certainly tradable, and if that fails, you get a second position. But if that breaks out, then there's no resistance in here whatsoever, so that should go fast up to about here. If it keeps going, Ken's looking at putting a second one right there. It has to get through that congestion. So getting a second one here is either going to work right away as it gets up to 250, or it's going to start failing right away, but that's where you cash it and enjoy that entire run up. So this looks great, like Coca-Cola here. Boy, every one of these is good. He finds good targets. I'm going to partner up his findings with my son's sniper pattern service and make that a separate subscription for people that want to just cut to the chase and trade in the simplified manner. Here's Brazil. This gives you a kata 2 to the downside because you have a high, a lower high. So you get, this is a kata 2 entry if this fails, and then this is where your second position with a collapsing dragon would come from. You know, that entry there is this one. If when you look at this on the daily, if this you have a tradable move down to 30.50 and then a second position at 30.50 on the daily. I'm sorry, yeah, so that one is this one. Yeah. SSC, kata 2, kata 2. And the fact that this cleared makes that well postured to get through all of this. And then that's no resistance at all. So the target is 37 to the upside. So there might be a little bit of slow going here if the rest of the market is weak. But if there was a nice move in the S&P and Brazil was tagging along, boy, this thing could really go. Because it's much, much stronger. Brazil and Latin America, much, much stronger than the U.S. But if there's a general pain and suffering, then there's a couple levels of failure to the downside with a target of 30 that could be useful. That makes this thing a great intraday trader. That's why it's a frog champion. Chevron has been benefiting in general from the strength and energy, obviously. And this little bit of support here gives you a kata 2 flavor up to 175. And if it breaks through there, then it's free and clear. So you like this kata 2 structure, a long position here. Play a single position to about 175. If it starts to stall, cut it. If it breaks through, add that second position with a very tight stop, and then enjoy the ride. W.R. Berkley Financial Services. Now, this is the anomaly in finance that it has been better than the other sectors. So here it is at the end of a really nice run up, is now holding at that critical state. Is it going to suffer like the rest of finance and just drop to earth? Or does it come up and test and then get a second position and a second wind and go? I don't know, but that's what makes it a nice critical state. And look how nice and tight he's got that box drawn right there. He's ready to go quickly here because if this fails, he wants to get a second position on. But if this works, that gap is no resistance whatsoever, and that thing should shoot right up to 68 and higher on not very much risk, on about a 30 cent risk or 25-cent risk. WRB. Target. Oh, this is a beautiful washout pattern here. Wow. There was about 800, was it 800 million in earnings shortfalls in retail? But retail just got slaughtered. That's how quickly the truth can change in that gap down. And now that it's trying to recover, notice the higher close. This is a perfect washout pattern for swings. The fact that it failed to fail and actually closed a little bit better makes this a very interesting play to the Bollinger Band mean and then the far side of the river and then closing the gap. So there's about, 3 legs up that are possible on a very tight risk. Boy, that looks good. So we want to watch the retail sector, and we want to compare that, Target versus Walmart in that space. Wow, that looks good. Let's see what Target offers here on the intraday. 90 cent for intraday risk, which means that it has a range stat of $9. So this thing could go from 154 to 163 pretty easily, all the way back up to the 3-day high. That's an amazing 5-day, range for you. So this thing is absolutely in Godzilla territory. That's monster Godzilla, king of the monsters. There, that looks really good. Ken H, you have found some amazing ones this weekend. Netflix, and the beauty of that is that those Godzilla patterns, once they start unfolding, can easily last all week for continuation patterns. And we're okay, and I think we've already seen Netflix. So we're in great shape here. I hear the girls upstairs, so we'll go out and get some ice cream, I think. Many thanks to Ken H. and Chi Wing Chong for setting us up for a week ahead of some just amazing opportunities. Netflix, Cisco, every single one of those things is high priority. So that's 8 to 10 symbols that should carry you through the whole week for sniper trading and swing trading one day at a time. So really well done, sir. Thank you so much. Take good care, and we will see you tomorrow.